Good morning and welcome, everyone. Thanks for joining the Blueprint team. My name is Matt Meyer, and this is our first educational event for our comprehensive advisor series. Our commitment at the Blueprint is to help educate our partners and change the narrative of how we discuss and help you position client solutions. As many of you know, we often ask our advisors what they are experiencing day to day and what their clients are saying to them. So we constructed this presentation with direct feedback to help address some of the concerns you may be dealing with in today's environment. As I value your time today, I'm going to keep this presentation to 20 minutes with some time to answer questions afterwards. So with that said, I'm excited to present fixed index annuities and how they can make a difference in client portfolios. But I want to emphasize this is not just an annuity presentation. We have people on this call that are very familiar with fixed index annuities and some that are new to this concept and may even feel uncomfortable when they hear the word annuity. So I will focus on the message we are trying to deliver, provide some feedback on the structure, but I'm not going to talk about caps, participation rates, or spreads. We can save that for another conversation. My goal is to help frame a story that we believe makes sense for you and your clients. But let me be the first to say that a fixed index annuity is not a silver bullet, but rather, when used appropriately, can be a complementary strategy that can help address market risk, mitigate behavioral risk, and may outperform bonds over time. Before I get into that, I'm going to provide some background on understanding risk in today's environment, which everyone on this call is well aware of, and how we can help manage that risk going forward. Lastly, I'm going to address how the insurance companies have evolved and utilized technology to help make doing business easier. Let's discuss understanding risk. We will address three main risks that we believe most advisors juggle daily in this environment. And I don't know if you're like every other advisor out there, but I talk to a lot of advisors, and one common theme that I hear is when the stock market is volatile, like it was in February, they get calls from their clients asking how they can de-risk their portfolio. Maybe not in those terms, but at least questioning how much they have invested. We know that this is also an example of behavioral risk at its finest. This is the second ball in the air, and we know it exists whether it's supported or not. And I know that I have those same emotions from time to time as well. And the third ball in the air parlays right into the first two, interest rate risk. We can all agree that we're in a low interest rate environment and can expect rate hikes in probably 2018 and more in 2019. So when we talk to successful advisors, we hear these common themes and frustrations that they share. And this leads us to what we believe is the modern day dilemma. On one side, we have clients that may want to flee stocks to fixed income. If you believe that the risk of interest rates rising exists, we know it isn't risk-free to flee from stocks to fixed income. One interesting note is that more than $14 billion went into bond funds in the month of April, which is the third consecutive month that it attracted more cash than its stock counterparts. We also talk to a lot of advisors who are experiencing the other side of the dilemma. They have large positions in bond funds and other fixed income. They are passionate about their belief in interest rate hikes and know that it will lead to losses. But what do? Flee to equities? They know that would be a hard sell to even the most disciplined client in this volatile market. So in essence, we see a rising interest rate environment that can negatively affect bond performance, a volatile 9-year bull market that has investors on edge of their seat, and they watch the constant noise in the media stoking the fear fire. So what do? By the way, this is the part of every annuity presentation they would tell you it's a silver bullet. Well, as I promised, we don't share that same belief. We do believe that when used as part of an overall asset allocation, the fixed index annuity can make a positive impact and address stock, interest rate, and behavioral risk of the modern day dilemma I just described. So let's talk about de-risking a portfolio and if a fixed index annuity can add value. For the purpose of this presentation, we're going to focus on analyzing a traditional 60-40 equity to bond portfolio versus a 60-20-20 portfolio, with cutting the fixed income to a 20% allocation and the remaining 20% with fixed index annuity exposure. In order to frame this discussion, we're going to refer to a detailed white paper by Roger Ibbotson, a retired professor from Yale University and chairman of Zebra Capital Management, somebody who is not in the insurance industry. The paper analyzes a variety of traditional portfolio constructions compared to adding alternatives utilizing fixed index annuities. As I mentioned before, we're not going to get granular into the product design, but the concepts in general and how they can make an impact, especially in a rising interest rate environment. Our examples will only focus on the fixed income bucket. For a general frame of reference, this is how dynamically the fixed index annuity measured up. Over this period of time, 1927 to 2016, large cap stocks returned 9.92%, bonds 5.32%, and fixed index annuities on the far upper right corner 5.81%. This is important because we're going to use this as a barometer for our discussions going forward. Now, let's look at this first slide. Let me explain, as the rest of the slides are similar with different assumptions. First, focus on the top of the page. The red highlights the interest rate change. In this example, a no interest rate change. Next, focus on the table below. Each of the next few slides will have the same market return assumptions Ibbotson analyzed: -10, flat market at 0%, +10, and +20% market scenario over a 3-year period. He essentially wanted to look at 3 possible scenarios for you and the client. The market will either go down, it will stay flat, or it will go up over the next 3 years. If rates stay the same, what was the impact on the traditional 60-40 versus 60-20-20 portfolio? So in this first scenario, with no change in interest rates, you will see that in a negative or flat market, a fixed index annuity had no positive effect. However, in a positive equity market, the portfolio with the fixed index annuity showed a higher return. Let's break down why this happened. In the most simplistic analysis, in a down market with no interest rate change, there was no positive effect because we replaced fixed income, which would have had a positive return, with a fixed index annuity, which had a 0% return. In the up market, we did see a positive effect because we replaced the fixed index annuity, or the fixed income bucket, with a fixed index annuity that was performing higher. Now let's look at scenario 2. Remember, the slide is the same layout, except the red at the top tells you that this slide represents a 1% interest rate increase over a 3-year period. The negative, flat, and positive market scenarios are the same. Now we can start to see a minor positive impact when the equity markets are flat or down. And we see a slightly more of a positive impact scenario when the markets are up. Let's break down again why this happened. In a down market, we replaced fixed income, which would have had a negative return, with a fixed index annuity, which had a return of 0. In the up market, we had positive effect because we replaced a fixed index annuity or fixed income bucket that had negative return with a higher performing fixed index annuity. Now let's look at the final scenario. Scenario 3 illustrates a 3% rate increase over that same 3-year period. This is where we start to see a significant effect in both negative and positive equity markets. The spread in both scenarios is also impacted. Let's discuss why these outcomes took place, and let's talk about the numbers. As we can see, in a 60-40 stocks and bond portfolio in a negative market, there was a negative 7.9% return. However, when we added the fixed index annuity to a 60-20-20 allocation, we had a better performing asset at minus 7%. The same scenario occurs in a flat market at minus 1.9% in a 60-40 stocks and bonds versus a 60-20-20, which was minus 1. In the up markets, we're starting to see a more positive impact. In a plus 20% market, we see a 12.7% return versus a 10.1% return on the 60-40 split. So, rates increase. What we see in the down market is the higher rate rise, the greater the positive effect, because you would have replaced fixed income, which would have had a negative return, with a fixed index annuity, which returns 0. In an up market, we have a positive effect because you replaced the fixed income with higher performing FIAs. The outcome is similar, but more apparent when we have a higher rising interest rate environment that puts more pressure on the fixed income bucket. Very simplistic analysis, but also one that has a great impact. So the bottom line is that in a rising interest rate scenario in a down market, the FIA performed at 0% return, which is better than a negative return for the fixed income it replaced. In a rising interest rate scenario in an up market, the FIA performed at a positive return, which is better than the negative return for the fixed income it replaced. So after all this data, some of you that are not familiar with fixed index annuities may still be asking what it is. The textbook definition, it is a tax-deferred retirement savings vehicle that eliminates downside risk while allowing for the opportunity to participate in upside market returns. The conceptual definition is that it protects your downside with worst-case scenario return of 0%, and it allows you to participate in some of the upside of a selected index. There's obviously more complexity to these investments, just like every other investment available when you dissect them. Our process is to help you understand the conceptual, understand where they fit, then teach you the complex when we sit down with you one-on-one. So can the FIA work for you? We think so. We think that it can address the 3 risks that many of you may be faced with in today's environment. Again, I don't think it's a silver bullet or a fit for everyone. The concept is simple if you believe rising interest rates will put pressure on fixed income portfolios. But what we're doing is challenging you and your clients, particularly in this low interest rate environment, to question conventional wisdom of asset allocation. So it may address stock market risk, it may address interest rate risk, and it may address behavioral risk that we deal with every day. I now want to wrap this up with a couple of comments on integrating them into your business. These investments have evolved tremendously over the past couple of years. There's a flavor for everyone. Canex is a tool we have access to that provides us with a breakdown of every fixed index annuity available. When you work with the blueprint, we don't offer one solution, but many, and we can use Canex to find the best solution for you. There are also fee-only options for those of you on the call that are fee-only advisors. There are commission options for those of you that want a commission. But the biggest strides that we have seen have been developed in the area of portfolio and report integration. We focus on RIAs and comprehensive advisors, and their number one frustration we hear is that annuities don't show up on my asset allocation reports for clients, or I have to add them manually with static values. This is where the industry is evolving, and some are ahead of others. Here's one example. Great American is an insurance partner with the Blueprint, and they have created data feed connectivity with several providers many of you may use. The green are all the firms that are currently integrated, that they're currently integrated with. We are starting to experience a shift in our business, which is why these insurance companies are continuing to evolve to meet the needs of our advisors and their clients. I think we will also continue to see more. So I want to thank everyone for taking the time today, and I know I was going to keep this short, and hopefully we provided a different perspective. Our goal is to continue this conversation with you. We'd like to meet and set up times to discuss and understand your business, to discuss if these strategies work for you and your clients, and then help implement them in the easiest and most efficient way. We can take a deeper dive on this idea or look to different ideas and solutions that fit your business. We take a white glove approach to our partnership, and we will share that process with you. So our goal is to reach out to everybody today and tomorrow to schedule a time to meet. I'm now going to open up the call and ask for any questions that somebody might have. So we had one question from John Balmer that was asking if there was any analysis on additional equity exposure with the fixed index annuity and how that would impact the overall portfolio. I'm going to go back and refer to a slide. And although Ibbotson did not allocate any additional fixed index annuities to the equity bucket, he did, however, show that if you took a 60-40 stocks and fixed index annuities versus a stock and bond portfolio of 60-40, as you can see here. So essentially, he removed the fixed income bucket and replaced it completely with the FIA. As we can see in this slide, we can see the positive impact it has by removing a negative fixed income bucket. Now, again, we see this scenario that in the same theme that we have is anything that's minus in the fixed income bucket that we're replacing with a zero in a downside market obviously has an impact. But as you can see here on the far right lower corner, we have a 15.3% return in a 20% up market over the 3-year period versus a 10%. So obviously our spread becomes wider as we're replacing this negative fixed income bucket. Now, we do have clients that are starting to look at allocations outside of the equities because of how much they've been up. But unfortunately, Ibbotson doesn't show those representations, but we can get a better feel for it when we look at the 60% stocks to 40% stocks and bonds. So I hope that answered your question, John. And we have one more question from Brian Samuels. He was wondering how we really look at the marketplace and what we do from our analyzation perspective. Well, as I mentioned, we have a tool called Canex, and for anybody that's worked with us, they know that we always take a product agnostic approach. So anything in the marketplace, we have access to 95% of the insurance companies out there, but more importantly, depending on the strategy of the client, if it's for income gap planning or for accumulation purposes or for a similar situation like this that we're talking about, replacing the fixed income bucket with fixed index annuities, we would look at a variety of different insurance products and design which one would fit appropriately. So our access is very broad, and it allows us to look at a lot of different scenarios, and we utilize technology and tools to help determine which is going to be the best client solution. And that wraps it up for today. So I thank everyone for having the time to take and listen to our presentation. We hope that it was valuable and look forward to following up and seeing how we can work and help partner better going forward. Thank you again.